Good evening, Western Standard viewers, and welcome to Hannaford, a weekly politics show. After it was clear that Donald Trump had won the U.S. election last week, the stock market roared. The Dow Jones Industrial Index surged 1,500 points, closing at a new record high, 43,730. So regardless of whether they liked Trump or not, a lot of people made a lot of money on November the 6th. My question then is whether this surge was an endorsement of Trump or a gasp of gratitude for certainty and a clear result in a controversial election. Here to make matters clear is Petar Pejovich. He is a Calgary-based senior portfolio manager at Wellington-Altus Private Wealth Canada. I know what he drives, so I think he's qualified to have an opinion. What about it, Peter? Does the market love Trump?
Well, thank you, Nigel. It's great to see you as always, and I'm really pleased to be on your show. And regarding qualifications, although I'm not a political scientist or pundit, I have been managing money for 27 years now and following global macroeconomic trends. And that's a foundational attribute for us here at Wellington-Altus Private Wealth. So I hope I can answer all your questions and share some knowledge with your viewers. And
well, great to have you here, Peter.
Thank you.
What do you think? What happened yesterday?
Well, I'll just answer bluntly, yes. So short answer is yes, although many see Trump as a controversial figure. The reality is that his victory opens the door to a new economic vision. And part of that vision includes a policy of deregulation. And that's a big one there. And markets appreciate that. So as we witnessed this week, both pre and post election, with the large gains seen in the North American stock markets, as well as other risk assets such as Bitcoin, both of which now sit at all-time highs.
Now, some people say that it was just the market responding to certainty. Had Vice President Harris actually won, would we still have had a surge like that?
Probably not. The certainty aspect of it does matter. Certainly, I know from our perspective as a money manager, we try not to be, let's just say, take one side or the other. We just need to know and understand what the policy will be of that administration. And as long as we know and understand what the policy will be, we know what to do next in terms of how we align our portfolios, to meet that policy. But what we have here really is an opportunity for the White House executive branch policy to better align with a more proactive monetary policy from the U.S. Federal Reserve, which may have a profound impact on risk assets and financial markets in the coming year. So, yeah, with Trump as president and his team featuring figures like RFK Jr. and Elon Musk, he claims to implement essentially a bold economic agenda, which he dubs American System 2.0. And the market likes that.
So you talk about a bold economic agenda. Now, there's a graph that we see that shows that the market improved under Mr. Trump's first administration, 2016 to 2020. I think it went up about, notes here, something like 15,000, sorry, I beg your pardon, about 15,000 points. But then it went up about that in the Biden era as well. So does it actually matter who's president?
Historically, if you run the regression analysis, short answer is no. In most cases, the answer would be no. However, there can be differences in policy agendas, which during certain market environments, or call it macro environments, may actually have an impact. And I believe this is one of those times. You see, we're at a time of essentially near unprecedented fiscal deficit, and obviously the highest levels of government debt. We've even if adjusted for inflation, the highest levels we've seen really since post-World War II era. And that's got a lot of people concerned. So the policy of this next administration and how they handle that fiscal deficit will be a huge clue to how money managers such as us, position our portfolios for the coming next 4 years.
So what are their alternatives? And what, in other words, what are you going to be looking for that's going to drive your decisions?
Yeah. So this is going to be essentially very tricky for them to navigate, but it is possible. It's been done before. So if you look at the era post World War II, we had actually a very similar environment to we had now. We just had a major war. There was, massive fiscal deficits. There was massive amounts of debt. That has to be corrected for, and if it's not, then that can create a fiscal crisis or massive recessions. So what do they need to do in the next coming years, and what are we going to look for? Is essentially this: they need to bring down the fiscal deficit first and foremost. It's just too high, and it's at a level that's wholly unsustainable for the future, our future, and the future of our children. Trump did hire, or he plans to hire, Elon Musk as an example. His primary role, at least what's been stated so far from what we know, is to cut $2 trillion out of the U.S. fiscal deficit. And that in and of itself is going to go a long way to give the market confidence that there will not be a fiscal crisis in the next coming years. If that deficit's not cut, then people are going to start to get worried.
Now that's a huge amount of money to take out of a budget, out of a government plan for expenditure.
Yes,
so
it is.
Yeah, I mean, it was also a huge amount to inject. But now that the people who were earmarked to receive it have got it, they're going to expect to get it again. They've made plans on this
Correct.
basis. What are the options, say it's Mr. Musk, what options does he have to do that? Just take the money away and brush everybody off? How does it go?
No, definitely that's not the way it needs to go. So this is the tricky part that can also be dangerous. Yes, there's a huge fiscal government deficit. However, that fiscal government deficit is essentially financing most of the growth that we have in the U.S. currently. So typically, it's difficult to take that amount of money out of the fiscal deficit and out of the economy without also impacting growth. And if you impact growth, you could end up with a growth scare, and a growth scare could end up leading to a recession. Could possibly. And so that's one of the major risks. So the plan that they have, at least from what we know, is they wish to take it primarily out of what they've used the word fraud, essentially. So they've actually used the word fraud, and I'm not saying that, but that's the word that they've used, where they believe that there's a lot of slush in the budget, where money is basically not going to where it's supposed to be going, and they're not even quite sure where it's going in some cases, again, according to them. So they believe that they can take, their words, hundreds of billions of dollars out of the deficit simply by doing a more careful accounting of where money is going to. So that's kind of step number one. Step number two, I mean, they've also campaigned on the prosperity for peace and to end the wars, whether it be in Ukraine or the Middle East. And certainly, if that's done, that could result in less money, essentially, being used for those purposes. Although the war money, if you want to call it, is a bit tricky because a lot of that money actually does stay in the U.S., meaning that U.S. might create bombs and planes and tanks and so forth and then ship them off, but the proceeds of that often do stay in the U.S. So they need to, in summary, they need to reduce the deficit, but in a way that will impact growth as little as possible to bring sanity back to the budget, and achieve a prosperity for the future.
In the earlier Trump administration, 2016 to 2020, I think all of us recall that as a time of prosperity and growth. Is that something that was a consequence of what President Trump did at that time? Can we expect the same kind of policy triumph in the 4 years to come?
So yes, but partially. One of the things that he did in his first term was he reduced taxes, and he reduced as well regulation, or he proceeded upon deregulation. So that's going to be an integral part of his plan, from what he has stated so far in his policy documents. That he does wish to reduce taxes, which is a double-edged sword. It's good for the economy and it's good for growth, but it's bad for the fiscal deficit unless done very carefully. And then the other part of it, and this is probably where he's going to put his largest level of focus on, is deregulation. He plans on essentially doubling down on deregulation and making it much easier for, say, banks to lend money through deregulation, which he would hope would spur the economy in the coming years to come. And I believe if it's done properly with a balance of reducing the fiscal deficit and deregulation and freeing up capital from the banks to put into the general economy, he might be able to pull it off, and that's what's got markets excited.
I think that's the key point. If that's what, so you're saying that it's his plans to deregulate that are going to drive the economy, and that's what's got the market excited.
That's the plan.
So
execution risk is always there, though.
As always, I face that every day when I come to work.
We all do.
I'm sure you do too, in your own way. So that's the plan. What you can't foresee the unforeseeable, but what are the risks that he would be very well aware of as he sets forth on this?
Yeah, so some of the risks may have been reduced here since it appears, at least, that the Republicans have a clean sweep. They have both the House and the Senate, as well as the executive branch. So there might be less opposition to him being able to actually execute on his policies, depending on how much opposition might actually still exist within his own party. But the main risk would be, well, there's a few of them. So, with increasing the amount of capital that's coming into the economy, future inflation is always a risk, if it's done improperly, because when you create new money, there is always a chance, if not done properly, that leads to inflation, which would not be good if we return to that again. The bigger risk, though, I would say, is fiscal crisis. So if he cannot properly cut the deficit without necessarily harming growth, we may end up possibly with a fiscal crisis by this time next year or early 2026, where essentially the bond market or the currency markets, might look at the deficit. If he's cutting taxes, but he hasn't necessarily cut enough, out of the budget, where they just essentially balk. They say, no more. We cannot continue to finance this. It's too much debt, too much deficit spending, and that could lead to a fiscal crisis and possibly a recession as well.
Now, this, of course, this is not something that he would be unaware of, or the people around him who are advising him would be unaware of.
I would hope not, and I would have confidence that he has enough people around him that he would be aware of this.
So I'm sure the question that everybody has who has anything to lose and a hope of gain is, that's very interesting, Peter. What do I do?
As an investor,
yeah.
So there's probably a two-pronged approach. First of all, it's important to have as many tools in your toolbox, so to speak, as possible. Most people might have potentially either all their money in the stock market. That of course then makes you beholden to what happens in the stock market. Some might have a balance of stocks and bonds, which gives them a little bit more diversification. But even that might not be enough in a low interest rate environment to give you adequate protection. What we would advocate for is a much broader and diverse asset base, where clients have a portfolio of good quality stocks good quality bonds, but also alternative assets such as gold, bullion, silver bullion, or other precious metals, and other alternative assets essentially that are not correlated to either the stock market or the bond market. And if you can structure a portfolio where you have a different group of assets that's not correlated or not similar to each other, that'll give you a lot of protection, depending on whether, say, Trump is successful in his endeavors over the next 4 years, or if he's unsuccessful, or what's probably most likely the case, something in between.
I noticed that when you began that answer, you initially said gold and then you caught yourself and switched to silver. Was that just to be inclusive, or were you thinking that silver's got more upside than gold? We have gold bugs who follow us, so I have to ask the question.
No, it's a good question. I grew up with a father who's a geologist, so I grew up around gold and silver my entire life, and this topic is very familiar to me. So I would suggest that there's probably a couple different reasons to own gold and silver, and probably silver does have more upside. Just to answer your question quickly, at least in the short term. Long term, it's a little bit harder to say, but short term, silver has lagged gold, and there's a lot of people that believe, myself included, that at some point here there's a reversion to the mean, and silver plays catch up to gold. And to play catch up to gold, it probably has quite a bit of runway room here to go to the upside. It's also looking very good from a technical or charting perspective. But beyond potential upside, I think there's two main reasons to own the metal that's not quote unquote speculative. One would be its correlation to both the stock market and the bond market, especially gold. Gold is not correlated to either the stock market or the bond market, meaning that the stock market and the bond market are do what they're going to do, and the gold market, for what it's worth, is going to do what it's going to do, and it's not necessarily wholly related. So when you blend the two together in a portfolio, you essentially get almost a magical outcome where volatility overall in the portfolio greatly decreases, as long as it's blended in the appropriate amounts, where returns do not go down, and they may even increase, over time. So correlation is one reason to own gold. The other reason is essentially insurance, and that's another large reason why we own gold. Is insurance in case of any sort of major calamity, whether it's war, or whether it's a fiscal slip up, let's just say, like we've been talking about. It's good to know that one has gold as a backstop to give insurance to the overall portfolio.
Well, does it actually support your point there that as the stock market surged yesterday, when the news of the Trump victory was incorporated, as it surged, gold went down? Is that the kind of correlation that you're talking about?
So when I say it's not correlated, I don't mean that it's opposite. I don't mean that if stocks are up, gold is down, and if stocks are down, gold is up. That would be essentially like an opposite effect. Non-correlated meaning that it's very difficult to discern a pattern between gold being up and stocks being down. Both can be true in a positive way, an opposite way, and anything in between, which is why it has such a wonderful property when blended with stocks. But yesterday did not surprise me with gold going down. Essentially, if you think of it this way, there was probably a moment there where there's a lot of investors on the sidelines that were thinking about putting money back into the stock market. They were thinking about it. They weren't sure. They were worried. They didn't know who was going to win the election. And then all of a sudden, Trump wins the election, and they're like, "Oh, I got to get in. I got to get in like yesterday, and like right this very second." But to get in, you often need to sell something to get in. And if you look at the performance of gold this year alone, I mean, it's up tremendously. So why not sell a little bit of gold and put it into stocks at that point in time and take some profits? So that was essentially profit taking on gold.
I see. We're getting close to time, Peter, but two questions to ask. Any thoughts on Bitcoin under a Trump presidency? And then we need to talk about the TSX. So Bitcoin first.
Yeah, now, and I'll be brief since we're short on time. Bitcoin has a lot of things going for it right now. Typically, it tends to do well post-election. So once an election has occurred and it's over, historically, it's almost always done well right after the election. Secondly, Trump is considered to be have a very, very favorable view to cryptocurrencies. I mean, he's even suggested, and RFK has even suggested that maybe the Federal Reserve should even be using Bitcoin as a reserve asset, which I'm not suggesting that they will do. But if they did, that would certainly be extremely bullish for Bitcoin. But also, Bitcoin is in its current seasonally strong period for the next, I'd say, 9 months or so. So overall, the prospects for Bitcoin look wonderful. And I believe you want to talk about the TSX next.
Yes, please. We've spent all this time on the American Stock Exchange. What difference did the Trump election make to the Toronto Stock Exchange, and what are the linkages there?
Quite a bit. So first of all, the Toronto Stock Exchange has radically underperformed all major U.S. indices, whether it's the Dow or the Standard & Poor's 500, and especially NASDAQ during the Trudeau era. So it's already been a very huge laggard in terms of performance. With a Trump presidency, it has the potential to even possibly make that worse unless things change and change quickly here in Canada. But essentially, if the U.S. was already a more, call it a free market type system than Canada, which is one of the reasons why it had its outperformance, if Trump comes in here and starts deregulating, and also another one of his objectives is to boost innovation, particularly in the tech space, i.e. artificial intelligence and blockchain data centers in the US. That could further the gap between Canada and the US unless Canada also, quote unquote, joins the party and embarks on tax cuts, deregulation, and basically an effort to spur productivity growth, which is also something that's been lagging in Canada for really the last decade.
Have you observed that kind of policy agility in the government of Canada and the Bank of Canada?
Oh, I mean, if you look at a history, I mean, during the Harper era, Harper, I believe, had a set of policies that made Canada very competitive during the 2000s. And the Canadian stock market during the 2000s actually radically outperformed the U.S. stock market during that decade. But unfortunately, the reverse has been true, over the course of the last decade or so. It is fixable, but we do have to change policies, in my humblest opinion, here in Canada in order to remain competitive with the United States.
Peter, and unfortunately, we could talk for a long time, and unfortunately, that's all the time we have. Perhaps we can end on an optimistic note. The U.S. Fed has cut interest rates by 1/4 point. I think that's good for us going forward, is it not?
Well, it's going to depend on how much we cut interest rates next. There's certainly a lot of reason to suggest that if we are less competitive than United States, that we may actually need to cut interest rates more than they do in the United States in order to try to bridge that gap. I do await to see the policy response in the Bank of Canada over the coming weeks. But overall, we do believe very strongly that interest rates will be coming down in both Canada and the U.S. in the coming months.
Well, there's a lot of us who will take much satisfaction from that. Thank you very much. That was Peter Pejovich from Wellington-Altus Private Wealth Canada, giving us his insights on what the Trump presidency is going to mean in the years to come. For the Western Standard, I'm Nigel Hannaford.